We just have a quick question here from Shauna about the difference between initial jobless claims and continued claims, asking for a little bit more clarity on how these two events, um, how they can affect the market and how we should be reading them. Now, these two data points, let's just go to our Zenith platform here, Shauna. So there we have initial claims as well as continued claims. Now, these two data points are usually released alongside each other every Thursday. And the initial jobless claims basically record all the new claims from a 1 week to the next, while continued claims record the total number of people continually claiming benefits. Now, as the two data points are released on a weekly basis, they can offer a more real-time glimpse into the overall US jobs market, which is why the market cares about them. And as we know, in terms of jobs, as it relates back to the US consumer, the consumer is about 70% of total US GDP. So the overall health of the consumer is a critical part of the US economy, which is why, in terms of labor markets, especially in times of great uncertainty, like during recessions, these type of gauges are very important for future expectations about growth. So during recessions, a steady decrease in initial jobless claims are usually seen as a positive for risk assets. And before going into recessions, a steady rise is usually seen as a negative for risk assets, as it points to some stress in terms of the labor markets. Of course, when you have one-off events like a global pandemic causing nations to completely shut down, that does cause recessionary pressures that normally takes months to make its way through the economy to basically happen in a few short weeks. And that is the massive trend we've seen and spike we've seen in initial jobless claims recently due to that coronavirus pandemic. Now, when looking at these two metrics, always keep in mind that in the more medium term, it's also important to keep track of the continued jobless claims and not only the jobless claims itself. And that should give you a truer sense of the possible recovery in terms of growth from a consumer perspective. So initial claims are usually expected, to drop off as the economy starts to improve. But even if fewer new people every week claim employment benefits, the real measure to see whether people are really getting back to work is whether there's also a decrease in the continued claims every week. So the continued claims becomes a better barometer, so to speak, of the overall health of the labor market, apart from, of course, your monthly NFP report as well. Now, for the biggest market reaction from this data series, always look for a significant deviation in both numbers. So both deviations, we would want them to happen in the same trend. So if we go to our must-read section for today, opening up that daily risk event outlook report. So in a print like today, we would want to see jobless claims coming in well below the market's minimum expectation, as well as continued claims also coming in below the market's minimum expectation. Or for a worse than expected print, we would want the jobless claims to print above the maximum expectation and continuous claims to also print above the maximum. So going back to today's print, for example, we had the markets anticipating a print of 1.3 or 1.3 million for initial jobless claims, but that came in worse than expected or higher at 1.4 million. And of course, for continued claims, the expectation was for almost 20 million, and that came at 19.5. So we had a worse than expected print for initial jobless claims, but a better than expected print for continued claims. So this is a really mixed print. Not really normally seeing a lot of market reaction from this. But even if we do have both of them coming in lower or both of them coming in higher, it normally has a much higher market reaction or impact when we see it printing below or above the market's minimum and maximum expectation. So we're not only looking for both of them to show improvement or deterioration, but also for both of them to show a print outside or below the minimum or above the maximum. And as always, apart from that, the overall market sentiment going into the event is also crucial to know whether it will have a big impact or not. Because sometimes, if sentiment is aligned in a particular way, if the macro themes are not really focused on employment data, for example, even if we do get a move outside the minimum and the maximum, it might not really have a meaningful or sustainable impact every single time. And because it really does depend on how the market is positioned ahead of that event in terms of the overall sentiment. So I hope that helps, Shauna. Any other questions, don't hesitate to let us know.